This is Bert Dohmen with Chart Guru for February 28th. Today we're going to discuss the chart of JCPenney's. JCPenney's came out with disastrous results yesterday with a drop of over 31% in sales in the last quarter. For a retail company, that is like death. The new CEO, well, he's been in there for a while now, but he came from Apple. He was a marketing whiz over there, but it was a totally different story at Apple. They only have about a dozen products or so. They have price fixing. They basically don't have any discounts, and which worked very nicely when you have no competition. But as Apple is seeing right now, the competition has appeared, and giving no discounts will be very bad for Apple. And when the CEO of JCPenney's tried to impose the same type of policy, namely no discounts, it drove customers away. In the department store business, you have to give discounts because you have thousands of competitors selling the same stuff. Here we can see the long-term chart. This is each bar of trading is 1 month of trading. Goes back to 1995. And here we can see the big decline from 1998 down to 2001. It was huge. And then we had the big rise in the next bull market going to the top in early 2007. And the big decline. So it's been a roller coaster ride for investors. The new CEO came in, and everyone became very bullish. Here is a big revival of pennies. And it was wrong. At the time, we said, this was over a year ago, we said that the new CEO isn't up to the job. He would eventually be fired. And hopefully that would be done before JCPenney's comes under great financial stress and credit lines are cut. I think now we're getting to that point where the financial situation of JCP will be called into question. That is never a good situation for any company. Let's look at the chart technically. Here we have a special stochastic indicator down here, and you can see when these two lines cross over, it's a very good long-term signal. When they cross to the downside, it's a long-term sell signal. When they cross to the positive side, it's a long-term buy signal. These are very good. They won't tell you day to day what to do because this is a monthly chart, okay? But they're very good in giving you the major trend. And you can see now that these two lines have crossed over again for a long-term sell signal. If we look at the chart here, we can see that this level here, which is around $14, and this level here, this one was in 2002, here's 2009, and it's around $14. So when the stock gets down to the $14 area, we should expect at least a bounce. And possibly the reason for that bounce will be because there will be rumors that JCP is looking for a new CEO. And so then we will get a rally out of that. But eventually, this is the more important support level. And this is at about $8. And so that would be good long-term support from the current $17. You can see this rise here that we had from 2009. This was the world crisis low. This rally here was nothing but a bear market bounce. If you use the Fibonacci lines, which are these dotted lines, you can see that exactly this is the 38.2, which is a Fibonacci level. It hit that exactly. A 38.2% retracement of the prior decline is nothing but a bear market bounce, whether it's on a monthly chart or a weekly chart or a daily chart. These ratio lines are very, very important in investment analysis. So if this was a bear market bounce, then we should conclude that although this will be first support, that eventually we will be going lower, and eventually JCP may be going much lower, which means, you know, below $5, after which the company might go out of existence, or at least the name, and the assets will be sold. So we are very bearish on the stock. There's no way that you can recover from the 31% sales decline. And in fact, if you take a look at the quarterly data last year, each quarter has seen a larger decline in sales than the prior one. This is a disastrous trend. Obviously, the new CEO is way out of his realm of expertise. He doesn't even live in Dallas, near company quarters. He tries to manage this huge company from San Francisco, which in my opinion is a big problem in itself. He commutes by private jet every week to the main office, which is not very productive, but that's not for me to say. I'm not a manager of a big department store. So, but if you're an investor, the short side would probably be the better side than the long side of the stock. This is Bert Dohmen signing off for today.
Sector sold responsible sectors favoriete.